In this video, we walk through Handout 10-5, recording and valuing bonds issued at a par, premium, and a discount. In scenario A, we're told that Johnson Controls has issued bonds with a $500,000 face value and a 7% stated interest rate. That stated interest rate is how much cash the bonds are going to pay out. The bonds mature in 10 years and pay interest every December 31st. The market interest rates when the bonds were issued was 7%. The market interest rate, that's the investor's required return. So investors are requiring a 7% return on Johnson Control bonds, and the bonds pay a 7% interest rate. So since the required or market interest rate equals the stated interest rate, the bonds will sell at par. When they sell at par, that means they sell for an amount equal to their face value, the $500,000 face value. Of course, we could also calculate that with our financial calculator. If we had put 10 in for the number of years, 7% for the market interest rate, $35,000 for the payment, and again, that's the face value, $500,000 times the 7% stated interest rate, and $500,000 for the future value, we would have solved that and found the present value of those cash flows was indeed $500,000. Let's go ahead and prepare the journal entry to record the first coupon payment on December 31st, 2021. Again, the coupon payment is simply that $500,000 face value times the 7% stated interest rate. Our interest expense is determined by the market interest rate and the net carrying value of the bonds. In this case, the net carrying value, the amount we issued them for, equals the bond's face value. So it's simply the $500,000 times 7%. Let's consider scenario B. Again, Johnson Controls is issuing the same bonds, but now we're told the market interest rate when the bonds are issued is 6%. So investors are only requiring a 6% rate of return to lend money to Johnson Controls. Their bonds are paying a 7% rate of return. Seems like a good deal. More investors will want to buy these bonds and will bid up the price. These bonds will sell at a premium. We can determine the actual amount of the premium by determining the bond's price. To do that, we're going to use our financial calculators again. This time, again, the maturity of the bonds in is 10 years. Our interest rate, the market interest rate, is 6%. The payment, once again, is $35,000. That's the face value times the 7% stated rate. And we'll enter in the face value as the future cash flow we're going to receive when the bonds mature. And we get a cash amount, or the amount we can sell these bonds for, is $536,800. Of course, we always record bonds at their face value, the $500,000. Now, obviously, debits don't equal credits. So we're going to need to credit the premium on our bonds payable for the difference, $536,800. Let's go ahead now and consider the payment of our first coupon on December 31st, 2021. Our cash payment on these bonds is simply the face value, the $500,000 times the 7% stated interest rate, just like in scenario A. Our interest expense will be different. It will be lower because our investors only required a 6% rate of return. Our interest expense will be the net carrying value of the bonds. That's the 500,000 bonds payable plus any remaining premium, which in this case is the 36,800, multiplied by the 6% market interest rate. So our interest expense is $32,208. Notice debits don't equal credits. We need an additional debit in the amount of $2,792. Our amortization of any premium or discount is essentially a plug. It's the difference between the two. And so in this case, we will debit or reduce that premium on the bond payable by $2,792. By the end of 10 years, that premium will have been reduced to zero, and our net carrying value will be $500,000, equal to the bond's face value. Let's go ahead now and consider scenario C. In our last scenario, Johnson Controls is again issuing the same bonds, but now the market interest rate, the interest rate that investors are demanding is 8%. So if investors are demanding an 8% return and Johnson's bonds are only paying a 7% return, they don't really seem like a very good deal. So investors won't be as interested and the price will fall. The bonds will have to sell at a discount. We can again determine the actual selling price of the bonds with our financial calculators or Excel. We will, in this case, again, 10 years for the time to maturity. Our market interest rate now is 8%. The payment is the same $35,000. That's the face value multiplied by the 7% stated interest rate. And then we enter in the face value of $500,000 as the future value and solve for the present value. Once again, we always record bonds at their face value, $500,000. Debits don't equal credits. We need an additional debit of $33,550. And again, it's simply the difference between the two. It's our plug. And we debit the discount on bonds payable. Looking at our journal entry to record the first coupon payment, December 31st, 2021, once again, our cash payment is the same $35,000. That's the face value times the 7% stated interest rate. Now, the amount of interest expense, though, will be slightly higher because recall, investors required a 8% rate of return. We calculate our interest expense by taking the bond's net carrying value, which in this case is the $500,000 minus the $33,550 discount, and multiplying it by the 8% required rate of return. We get an interest expense of $37,316. And we can see debits don't equal credits. We need an additional credit in the amount of $272.92. And again, it's the difference between the two. And so we will reduce the amount of the discount by $2,792. Eventually, over the full 10-year period, we will amortize the entire discount on the bond, and the bond's net carrying value will equal the face value of $500,000.